Hello guys, welcome back to another Lumley trading video. In this one we are going to be going through an options trading lesson, kind of where to use options, how to use them, kind of all the key things to do with options. Also, just as you can see, we are wearing some Lumley trading clothing. If you do want that, that is in the description. But to get straight into it and not to waste your time, kind of let's go over the reasons of options and kind of the benefits and disadvantages maybe to them. So firstly, we'll start off with the flexibility with options. So obviously, like most markets, if you're trading stocks, you're trading futures, you can make money whether it goes up or down, and that's kind of your limitations. Whereas the options allow you not to only make money going up and down, but you can also kind of make some strategies where you make money if the market stays flat. So that is kind of the flexibility they offer. We'll kind of go through some of the strategies you can use. So even if you don't know what options are, you've probably heard of calls and puts. And I mean, these are quite simple. And for this, again, I think it's always easier. We'll go through and kind of go back between the PowerPoint and the actual option chain so you can start understanding what it is. And firstly, this is an option chain. What you can see here is all the calls on the left, all the puts on the right, and the prices they are. So right now we're looking at an SPX, which is the S&P 500 index, and the options on that. So you can see if we were looking at calls, for example, current price is 3,924. So if we were to say, you know, we want to buy a 3,930 put, we can see firstly this is going to cost us about $1,350. Now, firstly, why is that? You see it says 13.3. You basically just times everything by 100. So firstly, that is kind of how much it will cost. What is your upside? What is your downside? So we can quickly go into analyze, trade, and see. So the benefit of buying calls or puts is firstly, your risk is defined. So you can see, let's say we pay $1,300 for this. You know, your max risk on that trade, if it goes completely against you, if the market crashed or anything, you would lose a maximum of $1,300. But the benefit of them is you have unlimited upside. You know, if it went up to say 4,000 on the index, you would be up $5,800. So that is firstly kind of the reason of calls and puts is you can kind of trade the direction of the market or the direction you think it's going to go, but you can also limit that downside. And this is one of the cases where options are quite good because you can define and kind of define your downside, but you can basically provide yourself with the unlimited upside. Now, obviously, there are going to be disadvantages with options, and we probably won't go through these things in this kind of lesson because these are a lot more in depth, but you do have something known as option Greeks, and that is just kind of different things. One of the key things being time decay, and this basically just means the longer you hold the option, they kind of just lose value over time. So that is one of the risks you have kind of with getting the advantage of having unlimited upside to the defined downside. But quite quickly, that is kind of just a call and a put. But again, I imagine you kind of already know, even if you're quite new to options, you probably already understand calls and puts. So to get into the next one, and actually this is a strategy I use quite a lot, and you probably heard about this if you've been watching the channel before when we do analysis on stocks. And this is vertical spreads, commonly referred to credit or debit spreads as well. So basically just, if we go back, basically just a trading style where you buy and sell options with different strike prices, but for the same expiration date. Just notice as well, we will move the face cam just to the other side because then it doesn't block out any text. But to get into an in-market example on the vertical spread, we'll go over to Tesla for this. And what you can see is, if we go over to the chart, where is currently Tesla sitting? So we're currently sitting around $188. So what we could say, let's say we are more bullish on Tesla. We expect it to close above 188, or say $187.50 because that's one of the strikes. So what we can go and do is forge an option using a credit or debit spread to say at expiration we expect it to close above that level, and if it does, we get our max reward. If it closes below, we take our max loss. And again, we'll go through that. We'll show you the risk to the reward on that. And again, we're going to go through this. You can see this expires today. We are recording this on the Friday, but you could go and do this, say, 2 months out, 4 months out, you know, a lot longer time. You'll tend to get kind of that still one-to-one risk to reward. But again, you kind of need to wait for them to expire to kind of make all of the money. So sometimes you may want to do short ones. Sometimes you may want to do long dated ones. But overall, what you can see is what you would do is you buy the 185 call. and then what you do is you sell the 187. So basically what you do is you buy the more expensive and you sell the cheaper one, and this makes a debit. Again, you can do it kind of inverse to create a credit, but the debit is quite ideal because what a debit does is obviously that means that's your max risk on the trade. You kind of know that going exactly into the trade. You can't lose more than whatever your debit is. So in this case, it's going to cost us $178. So what this basically means is, yeah, $178 is our max risk. So basically, if Tesla was to close below that $187.50, then we will start taking a loss. The only way we make a max loss of this is if it closes below $185. So, you know, if it goes between kind of those $2.50 area, you know, you're still taking a loss, but it's not going to be that max loss. You might only lose, say, $50 or $100, but if it goes all the way, obviously you're going to lose $180. Now, on the other side, if it ends up closing above that 187.50, what's going to be your max reward? And in this case, it's going to be $72. Again, the easiest way to kind of know what your max risk to reward is, you know, check the debit. Let's say your debit was $2. You can see the difference between the two strikes, so the 185 and the 187.50 is $2.50. If your max risk was, if your debit was $2, then your max reward is going to be $50. So that's quickly just how you work them out as well. But in this case, you know, your max reward is $72. So as long as coming into expiration, it closes above this level, then you make that $72. So again, probably not something I really trade as a day trading strategy, but it can be something if, you know, on the longer term move, it's really got hit, maybe oversold. For example, like right now in the current market environment we're in, you know, you have like First Republic Bank and a lot of the banking stocks getting hit really hard. If you think maybe some of the stronger banks, you know, the JP Morgans, the Goldman Sachs, are going to bounce, it's kind of just an overreaction. You could be looking at this kind of strategy now, that you're buying kind of where you think could be the lows. You're saying as long as it closes above this price come expiration, you make your max reward. And that's kind of one way you can tend to use this strategy, is just looking if a stock's really overbought or oversold. You can play the reverse one. Again, you can pick kind of how long you want to go out. For example, you could say, do that same exact strategy, but you could go out 150 days. And obviously you would have to do it a tiny bit different, but again, we can quickly see what it's going to cost. You know, you go to the 180 call, you go to the 180 puts, it's going to cost us $2.50. It's a $5 spread. So again, you know, we're getting near enough a 1-to-1 risk to reward. We're risking $258 to make $242. So again, it's really good and can be good, especially if stocks have been really overbought or oversold. So that's when I look to trade the vertical spreads. Now, on to another way, straddles. Now, this strategy I do actually use quite often. And basically what this does is where you buy both a put and a call at the exact same strike price with the exact same expiry. Now you may be thinking, why would you want to do this? Isn't kind of that just hedging each other out? Yes, it does somewhat, because obviously as the call rate pushes up in price, the put will lose it, and obviously the other way around. But what you're expecting with the straddle is that basically the call, if you, for example, it moves say to the upside, you expect the call to make more money than the put loses. And again, this only really happens if it's a big significant move. So one way that I like to be using this strategy is actually through news. For example, you know, recently, I think it was actually yesterday or the day before, we had the bank rate release. So if we go over to SPY, so obviously the S&P 500 ETF, we go 5-day, 5-minute. We can see on that Wednesday, we basically had the bank rate. Obviously, they released the bank rate at 2 o'clock, and at 2:30 the speech starts. So on these kind of things, you know, if you're expecting a big move, you could maybe be looking to go into this with a straddle. You expect the big move either way, then obviously you'll probably end up profiting. But again, some of this is going to be priced in. That's the thing with options. If a big movement is expected, like coming into earnings, there's a big movement expected, the premiums will be elevated. So you do always need to kind of be prepared for that. The premiums may increase a bit, which can make it harder to profit. But basically, if it just moves more than expected, that is where you can profit with it. So again, especially on this release, you know, people were unsure whether they would kind of hold the interest rate they were at, or if they would still hike, considering all the trouble we're having in the financial side of the market. They did do as expected, hiked by another 25 basis points. But, you know, people might have been going into that with a straddle, because if it didn't do what was forecasted, there would have been a much bigger move in the market, and those straddles really would have paid off. So that is kind of the benefit of using a straddle. Again, you don't need to, you just know there's going to be a big move, but you don't necessarily know the direction in which that move will happen. Iron condors, not something I personally ever used, but it is still a big strategy. So we'll go through this, but you can kind of see what it involves is selling one out, the money call option, and then buying another one, but even further out, and doing the same to the put side. Now, the point of iron condors is if you expect the market to stay flat, and again, we were talking about kind of market neutral strategies where you can make money if the market doesn't move, that's when you use an iron condor. It makes money basically if it doesn't move outside of the range that you create. So again, we'll go through the option chain just to make it as kind of clear as possible. Again, we'll just use kind of SPY for this. Let's say right now, we can go to today's price. We can see we're currently at, you know, basically $393. We could say we kind of expect it to stay within the range of $395 to say $390. So $395, we will sell that one, and then we will buy the cheaper one, say the $396. So that's one side of the iron condor. And then what was the other range we said? We said we don't expect it to go below the $390. Again, then we go over to the put side, we do $390. We will sell the more expensive one, $390, and we buy the cheaper one, the $389. And we can see this gives us a credit of around 68 cents. So again, if we go over to analyze trade, what does this mean? So if it stays within this range, we make those $68, $69. If it ends up breaking that range, we take our max risk, which in this case is $31. So in this case, there's actually good risk to reward, but again, that's because it's quite a tight range. Very likely that we don't stay within this range coming into expiration. But that's basically how you use this strategy. Again, not something I personally ever really use. But if you were looking to trade, you know, a neutral market, iron condors will most likely be the route you take. You can also use straddles. Again, we won't really go through that in this video. Basically the same thing, it's just a lot more expensive. So yeah, I mean, straddles usually about 10 times the price. So in this case, you know, we're looking to lose, you know, we're looking to make $69. We're looking to lose 31. In a straddle, it'd probably make about 690 and we'll be risking about 310. So it can be good if maybe you were looking to do a couple of iron condors, because you can reduce your commissions by going through a straddle. But overall, they are pretty similar. If you want a video on that, we can go through that more in depth in the future. But on to the next bit. So those were kind of the key strategies we talk about. Now we're talking about kind of the next benefit onto options, and that's limiting risk. So we did talk about this, I mean, I guess through talking about the other strategies. But yeah, what's really good with the options is it's kind of clear how much you're going to be risking, because that's one of the downsides, especially with futures, I find is, let's say I'm trading something, let's say news coming into futures. Obviously, the spreads get very wide as the news release comes out. So especially if you went the wrong direction, cool, you might have your stop, let's say the S&P is at, you know, 4,000, you have your stop at 4,010. You're probably not going to get filled at that 4,010. So again, your kind of risk is a lot less known, because again, the spreads can be wide. You can't exactly define your risk. And I think that's one of the main advantages going through the options, is you can know going into a trade exactly your max risk. And as well, it can be a benefit. Let's say if you maybe live in an area with bad Wi-Fi, I mean, probably not the best thing to be trading, but let's say your Wi-Fi cuts out quite a lot, you know, that's another big benefit to the option, because you know you're going to come back. You can't be down 30 grand if your max risk was 1,000. That's the difference of futures. If you got a 50k account, and you know you were only looking to risk 1,000, but maybe you haven't placed your stop yet, you just get out manually. Your Wi-Fi crashes and you can't get on for say 5-10 minutes. You know you could come back. You could be down massively. Again, you're probably not going to encounter that over in the options market, because most of your trades are going to be risk managed or risk defined. Then leverage. So obviously, like futures is very leveraged as it is. Obviously, options are leveraged, and then when you go to stocks, most of the time isn't going to be isn't leveraged. The stock isn't going to be leveraged. Obviously, you may be able to get some margin from your broker, but again, you're still kind of taking on extra risk Obviously, you have all the upside potential, but you also have all the downside potential using that kind of margin on both, obviously on the futures and the stocks. But again, that's another benefit I find to the options market. You can get a lot of the upside leverage, but you can still limit your downside. So especially, you know, when we were talking about the call or the put options, you know, let's say JP Morgan stock was at $100. We think it's going to go to 110, but we might say, oh, it might pull back $10 maybe before it does that. Say I can't sit through that kind of pain. What an option will do is, okay, if it goes against me the $10, I can lose what's in the option. That's fine. You know, that is your risk defined amount. You can kind of lose that. But if it goes up to 110, obviously you make the money you expected, but it can also run more. And, you know, your upside is never going to be kind of limited. If it goes up to 150, you're making all that money while you still have that defined and kind of risk managed downside. Hedging, again, another key thing of options, and really the main reason they were created in the first place is a use of hedging. And so this, I don't tend to use it too much because I don't tend to swing trade stocks all that often, but it can definitely be a useful kind of method to use. Let's say you're shorting Apple shares, and we can kind of go through this now. Say, yeah, we're trading Apple, we think it's going to fall in price, and we say shorted shares at $158. Obviously, if markets close tonight, we open up tomorrow, big Apple news comes out and it shoots up to $200. Obviously, we're down $40 a share. Can we hold that pain? Probably not, because you probably weren't expecting that kind of stop. Maybe you had your stop at kind of above that high of around 162. So, you know, you were kind of allowing risk of around $5 a share. But, you know, for some reason, big move after hours, it went $40. Again, not too much you can do about that unless you are hedging. So all a hedge would be is, yeah, cool, we short those 158 at 158. We go over to the Apple options. I mean, we could be using shorter or longer term dates. Again, that's all going to be personal preference. But let's say we're looking to hold the trade for a week. We're going to close it out in a week. We could be looking at a week. We can say, okay, if it goes above $165, that's where, you know, we really don't want to be taking on any more risks. So what we would do is, let's say we shorted 100 shares of Apple. We buy one. Cool. Again, you can buy more if you kind of want to overhedge the risk. But it would cost us $40, but it kind of then just defines our risk. So even if it went up, you know, to $200 overnight, you only take your loss on what you're expecting up to the 165. So, you know, you're risking $7 a share. And that's really your max risk, because obviously then the call option will kind of hedge that risk and make all the money that you would have lost elsewhere. So that's really a big reason for the options, is just hedging. And one of those key things, I know a lot of people trade the small caps. If you're trading small caps, that can definitely be a great way, because they can move, you know, 30% overnight, and that's not all that unlikely. Then on to protective puts. So again, and one of the key things actually we'll go through first. So it involves buying a put on a stock or future that you already own. So, you know, again, we can use Apple as that same example. We own it at $150. Let's say, you know, maybe earnings is coming out. You want to be protected if it goes to the downside, but obviously you want to stay in the stock for the upside potential. That's when you can buy protective put. So if it does crash to the downside, obviously your losses will be limited. But what could then also be the benefit is tax benefits. Obviously, especially maybe if you're not so much trading but investing, you're buying, you know, you got your Apple at 150, earnings is coming out. Usually you just lock in profits here and take your money. But let's say you maybe held it for 11 months, you haven't got that 1 year tax deduction. So you don't want to sell them yet. So instead you can buy a protective put. So if it does go to the downside, you know, you're spending a bit of premium to do that, but it will probably be cheaper than what you'll be paying in taxes if you end up closing early. So that's one of the big benefits of protective puts. Cover calls, same kind of thing. If, you know, you own a stock to the long side, again, we'll just use Apple as another example. We own it at $150. What we can do is we can say if Apple goes to $160, you know, that's probably where we want to start locking in profits, let's say. So what we would then do, or let's say what are we now, 159. So let's say we just bought it now. If we went to 165, that's when we would want to start like locking in profits on Apple. What we can then do is go over to the call side. We would sell a 165 call, and you can see what we would make is $40 for doing that. So this money you make no matter what. If Apple goes up, down, stays exactly flat, you make $40 today for selling that call. Now, what are the risks and the downside to that? So it limits your upside. So obviously if you're holding shares long, you normally have a limited upside. In this case, you're limited to your average price to the strike. So again, if we were buying at, I think we said 158, there's a $7 strike difference between the two. So your max profit is $700 on the shares plus the $40 you make for selling that. But again, for this, you do need 100 shares, by the way, because an option is always 100 shares. So again, your max risk, your max profit then is now limited to $740. So even if it, shot up to $200, you're still only making $740. So that is kind of the downside of a covered call. It limits your upside, but again, it can also be used as a hedge. If you think prices are going to fall, again, you sell those covered calls, you make money, or you make that premium, even if Apple fell down to say 150 tomorrow, you still keep that $40 and kind of just, can offset your losses that tiny little bit. So that's kind of the benefit of using covered calls. You can kind of just hedge or kind of receive income from using your kind of already owned stocks. And yeah, if it starts falling, you can kind of hedge that risk. But if it goes to the upside, you can still make premium. But again, it does limit your upside. And that can be one of the big downsides of covered calls. And again, especially if you're on the investment side of things, you need to be watching out for covered calls because, again, you need to know if it executes the covered call. Obviously, you have to kind of sell your shares off at the strike you pick your covered call at. So if you haven't held the shares for a year, again, you're then going to be hit by not the long-term capital gains, but just normal capital gains tax. So again, you need to be taking that into account if you're doing covered calls on an investment portfolio. Collar. Not something I'm really going to go through. I thought I'd throw it in because I do hear people trade of them, but not something I've ever really touched myself. I personally don't even know too much about them. But what you can see, it just involves buying a put and selling a call option on a stock or future that you own. So again, kind of protects your downside, but it it can also offset your upside. So again, to me, I don't really like collars. I don't think I would ever really use them. But I thought I'd just add it in there just in case you wanted to kind of know what they are. Now, income generation, again, another big kind of benefit to options, which you don't get. Obviously, in stocks, you can get dividends. That's about it. Futures, you're not going to get any sort of income generation. So that's kind of one of the big benefits over on options. Now, covered calls, again, something we went through before. But like we said, if the stock price is going up, or stock's going up, we can still sell those covered calls. Oh, actually, the stock can be going down. That doesn't really matter. But we can sell those covered calls. We receive that premium. So when we're going through the example before, that's where we make the $40 on Apple. So we receive that $40. No matter what happens to the stock, we make that $40. There's your income generation. Cash secure puts. This is actually one I really do like, especially on an investment account. And what this basically does is this sells a put of a stock you own nothing of. And if it executes, obviously, so basically, let's say you sell an Apple $100 put. If it closes below $100, you have to buy the shares. But this is really good, especially from an investment standpoint, if you're trying to buy a stock. And we'll kind of go through that and kind of why that is. Apple currently sitting around $160. Let's say we want to buy it if it goes to, say, $155. So what we do, we look at the puts and we would sell a put. We can see we make just under $100, $99, if we were to sell this. So what this basically means is if Apple comes down to $100, or $155, and closes below that level, we have to buy the shares no matter what price they are. So even if Apple was exactly on 150, say 154, we have to buy them. If Apple was at $140, we have to buy them. So it means you have to buy it no matter what, which I guess is some sort of the risk you take. But if it was a stock that you wanted to buy, so you want to buy Apple now, you want to buy it, say, around $150, $155, you can use this cash secure put, so you will buy it if it hits a price that you want, but you also get paid to do it. You get paid that $100 to basically be a bit more patient and wait for it to hit your desired strike. So that's kind of the benefit to it. Again, obviously you do take the risk. If it continues to fall, you lose money. But obviously it's the same if you were to buy the shares. If you were to buy your shares at 155, you still got that exact same downside risk. So it's one of those things. Yes, you still take that downside risk on a bit earlier before you own the shares, but for that you do get paid kind of to buy the shares that you want to buy. So that's why I really like it, because you can kind of get paid to buy the shares that you want. Selling credit spreads, again, kind of the thing we went through before with the vertical spreads, but don't really need to go through that. But you can kind of just get paid and kind of receive daily income. By a lot of people trade 0 day to expiries on, say, the S&P. As long as it stays above or below, sometimes people do it on like yesterday's range, you can profit, but a lot more of a riskier option, not something I really like for the income side. So that is basically everything. I think quite a quick lesson into options. So just let me know if you have any questions on this, and let me know if you want to do me to do more of kind of these lesson styled videos. Anyway, I hope you enjoyed the video. If you did, why not drop a like and subscribe, and that's it. Peace.